Welcome back to Talk Tickers. If you are tuning in today, you are likely nursing a bit of emotional whiplash from yesterday's market action.
I think whiplash is the right word.
We are diving deep into the earnings call for Aptiv ticker APTV, which took place yesterday morning, February 2nd. And honestly, watching that stock trade yesterday felt like a psychological thriller.
It was the textbook definition of a reversal.
Yeah.
You look at the pre-market, and the stock is down over 3%.
Right.
The algos were just reading headlines, seeing margin pressure, and hitting sell. Everyone was panicking about the auto cycle.
And then
the call happens. The details come out. And by the closing bell, we're up 2.9% at $77.98.
that is a massive intraday swing. And that's exactly why we do this deep dive. We're here to unpack the noise for the serious market watcher, because if you just looked at the headline EPS number, you missed the actual story.
Oh, completely. This wasn't really about Q4 results, was it?
It doesn't seem like it.
Not at all. Q4 was the appetizer.
Oh,
It was
yeah.
fine. It was solid. But the market didn't buy that reversal because of the last 3 months of 2025. They bought it because of what's going to happen on April 1st.
The big split.
We're looking at a massive corporate divorce, a spinoff that fundamentally changes the thesis, combined with forward guidance that, well, it caught the bears completely off guard.
Okay, we are definitely going to unpack that divorce, this spin-off of the Versigent business, and why the guidance saved the day. But before we get to the future, we have to eat our vegetables.
Let's do it.
Let's look at the actual scorecard for Q4. What did the print look like?
So the headline numbers were a beat, but, a modest one. Revenue came in at $5.2 billion, up 5% year over year.
Okay.
That's about $100 million over what consensus was looking for. And then adjusted earnings per share EPS that landed at $1.86. The street was at $1.85.
A penny beat. In this market environment, a penny beat usually gets a shrug, or if the guidance is weak, you get punished.
Exactly.
Yeah.
We aren't popping champagne over a single cent. And that explains the initial drop, because when you look under the hood at the margins, that's where the ouch factor was. Adjusted operating margin came in at 11.8%.
And a year ago.
A year ago, that was 12.7%.
Wow, that's almost a full percentage point drop. In the auto supplier world, where you're fighting for every basis point, that is significant.
It is.
It suggests something is eating into profitability. Was this an execution error? Did they lose pricing power?
No, and that's the key defense management had. It wasn't operational clumsiness. It was external macro factors, specifically foreign exchange and commodities.
Ah.
The Mexican peso and copper prices were the villains here. They cited $66 million in headwinds just from those two factors.
Let's pause on the peso for a second. Why is Aptiv so exposed there?
It's their manufacturing footprint. A huge portion of their labor force, especially for the wiring harness business, is in Mexico.
So when the peso strengthens.
Exactly. When the peso strengthens against the dollar, their labor bill effectively goes up overnight. You're paying workers in pesos but collecting revenue in dollars, so a strong peso just eats your margin.
And copper. Well, if you're making wiring harnesses, you are basically buying copper by the metric ton.
You're in the copper business whether you like it or not. And this copper issue is actually the perfect segue into why this company is splitting in two.
Before we get there, though, how was cash flow?
It's worth noting that despite the margin pressure, they generated $818 million in cash from operations in the quarter. The business is printing money.
So the engine is still running.
Oh, yeah, even if the margins got squeezed. And the market was watching. Volume was 3.08 million shares yesterday. That's about 136% of the average.
So money is changing hands. People are positioning. Let's talk about why. The strategic split, Project Versigent. We have a date now.
We do. Management confirmed it. The spinoff of the Electrical Distribution Systems business, or EDS, is officially happening. The new independent company will be named Versigent, and the target date is April 1st, 2026.
April Fool's Day. I'm sure the headline writers will have fun with that if anything goes wrong.
I'm sure they will.
But let's get to the logic. For years, the argument for Aptiv was integration. The nervous system, the wiring, and the brain, the software all under one roof. Why break them up now?
It comes down to the conglomerate discount.
Yeah.
The market, it hates complex stories. Right now, you have two very different businesses mashed together, and they're canceling each other out in the stock price.
How so?
You have the new Aptiv, which is focused on intelligent systems, software, sensors, compute. That's a high-growth business that should command a tech multiple.
Like a NVIDIA or a Mobileye type of valuation?
Ideally, yes.
Yeah.
Or at least a high-end industrial tech multiple. But right now, it's being dragged down by the other half of the business, Versigent.
the wiring and connectors.
Right. Versigent is a massive industrial business. It doesn't grow fast. It's capital intensive, and it's totally exposed to copper prices. But it generates a mountain of cash. It's a yield play.
So by keeping them together, the growth investors won't buy it because of the boring copper wiring, and the value investors won't buy it because of the risky software spend.
Precisely. It's the worst of both worlds. By separating them, you unlock the value. The growth guys buy new Aptiv, the dividend guys buy Versigent. Simple stories.
Okay, that sounds great in a slide deck. But divorces are messy, and they involve dividing the assets. I saw a detail in the capital structure that made me raise an eyebrow.
I think I know what you're talking about.
New Aptiv plans to pay down about $1.9 billion in debt, but they aren't using their own checking account to do it.
No, this is where the financial engineering gets interesting and maybe a little aggressive. They are funding that debt pay down largely by taking a dividend of about $1.6 billion from Versigent right at the moment of the spin.
Hang on. So the old, slower growth business, Versigent, is basically taking out a massive loan to pay the new, sexy tech business a parting gift.
That's one way to put it, yes.
Isn't that hampering Versigent right out of the gate? That sounds like you're loading up the mule so the racehorse can run light.
It's a fair critique. It's definitely a private equity style move. You're leveraging the cash cow.
But can it handle it?
Management would argue that Versigent can. Even with that debt, both companies are targeting a leverage ratio of about 2.0 to 2.5 times debt to EBITDA. Because Versigent prints so much cash, it can service that debt. But you're right, it gives New Aptiv a massive head start with a pristine balance sheet.
It really feels like New Aptiv is the favorite child here. But let's look at the guidance, because that's what really turned the stock around yesterday. Going into this call, the vibe was grim. Everyone expected a guide down.
That was the fear trade we saw in January. And think about the macro context. We've had headlines about EV production cuts, interest rates staying thwicky, general auto cycle fatigue.
The whisper number was low.
The whisper number was that Aptiv would have to lower their outlook. Instead, they did the opposite.
Walk us through the numbers that shocked the bears.
For the full year 2026, looking at the total combined company, they guided revenue to a range of $21.12 billion to $21.82 billion, an adjusted EPS of $8.15 to $8.75.
And crucially, where was the consensus estimate for that?
It was lower across the board. And maybe more importantly, the Q1 2x026 guidance came in strong too.
Q1 is always the one to watch. It sets the tone.
It does. If you miss Q1, you're chasing the whole year. But they guided Q1 revenue to $4.95 billion to $5.15 billion. That immediate confidence is what caused the reversal. Investors just realized, wait, management isn't seeing the cliff edge we were terrified of.
But I have to play devil's advocate. How are they hitting these numbers if the EV revolution is stalling? We read the same news. Ford, GM, everyone's tapping the brakes.
And that's the nuance that you have to grasp. The EV collapse narrative is overstated. Management assumes the EV market grows about 15% in 2026.
Okay, so not the 50% growth we dreamed of a few years ago.
No, but 15% growth is not a contraction.
Yeah.
And most of that growth is coming from China. They're just less bearish than the broader market fear gauge.
So it's a deceleration, not a decline.
Exactly. And because Aptiv sells the brain and nervous system, they get content gains even in hybrids and advanced gas cars. They aren't purely tethered to the battery electric vehicle.
Let's loop back to those headwinds. Copper and the peso. If Versigent is spinning off, does New Aptiv just get to walk away from those problems?
Mostly, yes. And that's why the split is so attractive for the New Aptiv story. Copper is a huge input cost for wiring. Management is budgeting for copper at $5.50 per pound in 2026.
$5.50. What was it last year?
In 2025, it averaged around $4.51.
That's a huge jump. That's massive inflation for them.
It is. And that cost sits heavily on the Versigent side of the ledger. By spinning it off, New Aptiv becomes an asset-light, commodity-neutral software business.
But I have to ask, we hear this term pass-through all the time. Oh, we just pass the cost to the customer. If that's true, why did margins drop in Q4?
It's all about the lag. And this is the detail that matters for your modeling. Yes, they have contracts that say if copper goes up, Ford pays more. But typically, there's a 3-month delay.
Ah, so it looks backward.
Exactly. So when copper spikes suddenly, Aptiv eats that cost for a quarter before the price hike kicks in. It makes the sequential margins look lumpy. It's a timing mismatch, not a permanent loss.
Okay, that makes sense. And what about the peso? Did they fix that?
That $66 million hit was largely because they weren't fully hedged in 2025. They kind of admitted they got caught. For 2026, they've hedged about 95% of their exposure, below the 18 peso level.
So they've built a financial wall around that risk.
They have. But you can't hedge against a missing part. A few years ago, the whole story was chip shortages. Is that nightmare finally over? For Aptiv, it seems to be, but it came at a cost to cash flow. They made a strategic choice to build up inventory. They're sitting on about 12 weeks of semiconductor inventory right now.
12 weeks, that is 3 months of chips sitting on a shelf. That's a lot of working capital tied up doing nothing.
It is, and it dragged on their free cash flow in Q4. But think about the alternative. If you're short one chip, you shut down an assembly line. That inventory is an insurance policy. Management sees minimal impact from shortages in 2026 because they're sitting on that stack of chips.
I want to pivot to something I think gets overlooked because we're so focused on cars. There was a lot of chatter on this call about non-auto, industrial defense.
This is the sleeping giant in the valuation. They are aggressively moving into industrial markets. And the buzzword here isn't just automation, it's robotics.
Mobotics. Okay, are we talking about the robot arms that weld cars together? Because that's a crowded market.
No, we're talking about autonomous mobile robots, warehouse bots, logistics.
Okay.
They announced partnerships with Robust AI and Vecna Robotics. But the key here is their software subsidiary, Wind River.
Wind River, the platform they bought a few years back, people were confused by that acquisition at the time.
And now it's acting as the tip of the spear. They're tapping into a $6 billion total addressable market just for robotic software. Here's the insight. An autonomous robot in a warehouse needs the exact same tech stack as a self-driving car.
It needs to see, think, and communicate.
Precisely.
But there are 100 startups in Silicon Valley building robot software. Why does a car parts company win here?
Because of the automotive grade mode. This is the crucial differentiator. A startup's code might work 99% of the time. But Aptiv's software is built to safety standards designed for vehicles moving 70 miles per hour on a highway. It is hyper-reliable.
Ah, mission critical.
Exactly. Taking that software and porting it to a forklift moving 5 miles per hour gives them a reliability advantage a startup just can't match.
That makes sense. If I'm running a warehouse, I don't want the robot crashing into shelves. I'll pay for the car-grade brain.
And the margins on that software are likely much, much better than selling a plastic connector. It's still early days, but they're framing this as the primary growth engine for new Aptiv.
Let's zoom out to the map. North America is doing the heavy lifting.
It really is a tale of three regions. North America is the workhorse revenue, up 8%. That's strong. Europe, on the other hand, is sick, flat to down.
And then there's the elephant in the room, China.
China is fascinating. If you just look at the revenue line, it looks bad, down 5%.
Which usually signals a disaster.
Usually. But it was mostly mixed issues. The real number to watch is bookings. They booked $5 billion in new business in China.
Okay, but let's clarify bookings for the listener. A booking isn't a sale today, it's a promise. How much stock should we put in that $5 billion number?
That's a great question. In auto, a booking is a contract for a vehicle platform that might launch in 2027 or 2028. It's a signal of future market share. And the kicker is that 80% of that $5 billion was with local Chinese OEMs.
So not just Ford and VW in China, they're selling to the locals, BYD, Geely, Xiaomi.
Correct. That's the China for China strategy. They are embedding themselves into the supply chains of the companies that are actually winning the Chinese market. So while revenue's down today, the bookings tell us Aptiv will be inside the winning cars tomorrow.
So bring this all back. Yesterday morning, the narrative was Aptiv is a struggling auto supplier. By the afternoon, it shifted.
It shifted to Aptiv is an execution story with a clear catalyst. The market is effectively deciding to underwrite the spinoff. Investors are looking past the messy Q4 margins and saying, okay, we believe you.
April 1st, we get two companies.
We get the cyclical yield play in Versigent, and we get the tech compounder in new Aptiv.
And that brings us to the most fun part of the deep dive. We have looked at the past, we have looked at the guidance. Now let's look at the opportunity.
Disclaimer time.
You know the drill. This is Talk Tickers. We are here to entertain and inform. This is not financial advice. We are just two voices in your headphones. Do your own work. But if you're pitching this today, what's the wild but plausible trade?
I call this one the robot call option, or maybe the pre-divorce arbitrage.
The robot call option. I'm listening. Pitch it.
Here's the setup. Right now, every algorithm and generalist investor looks at ticker APTV and sees a copper-heavy, labor-intensive auto parts maker. They see that $5.50 copper price, and they apply a low multiple.
A dirty industrial multiple, maybe 10 or 12 times earnings.
Because right now, mechanically, that IS what the company is?
Until April 1st.
On April 1st, the copper wire gets cut. Versigent takes the commodity risk, the labor intensity, the debt. What's left behind in Remainco New Aptiv is a software, sensor, and compute business. It owns Wind River. It's entering robotics.
So you are buying a robotics and AI software company that is currently priced like a copper wire factory.
Exactly. The trade is to go long Aptiv now. You sit through the next 2 months of noise. You let the spin happen. And suddenly the market wakes up on April 2nd and realizes, wait, why are we treating this AI compute business at 12x earnings when it should be 20x or 25x?
You're playing the re-rating, betting the market is too lazy or distracted to price new Aptiv correctly until it stands on its own.
It's essentially buying a robotics software startup that happens to be wrapped in copper wire until the wrapper falls off. And remember, because Versigent is paying that dividend, new Aptiv starts life with a clean balance sheet. It's arguably one of the cheapest ways to get exposure to this whole mega trend.
I love it. It's contrarian, it relies on market inefficiency, and it has a hard catalyst date.
Just keep an eye on that copper price. If it goes to $7 before April, Versigent might have a rough start, which could drag sentiment. But for the robot call option, it's all about the software stack re-rating.
So to wrap this up, Aptiv Q4 2025, a quarter that looked ugly on the surface due to currency and copper, but was saved by a bullish 2026 guide and really the clarity on the spinoff.
The volatility we saw yesterday morning offered a buying window that it seems the smart money pounced on by the close. Now we watch for the Q1 margin conversion and the specific filing details for Versigent.
And we will be watching right along with you. April 1st is the date to circle on your calendar. Until then, keep watching the tickers.
See you next time.